You have to remember it's been a long time since we had, basically, it's been, uh, 17, going on 17 years, almost since the last, what I call generational bear market. So somewhere, in this next year or two, you're probably going to get to that point, and then, the game changes again. But right now, everybody's pretty drunk on where they are, so you can't sober them up right now.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Stock valuations are pretty much at their highest ever by many metrics. So much so that a recent guest on this channel called them pornographically overvalued. And these lofty valuations come at a time when the macro data reveals the economy is slowing down. How long can this dichotomy last before either stocks must reprice downwards or the economy picks up? For seasoned expertise, we've got the good fortune to welcome back to the program high net worth financial advisor Ted Oakley, managing partner and founder at Oxbow Advisors. Ted, thanks so much for joining us today.
You bet, Adam. Good to see you again.
Great to see you, Ted. Look, a lot has happened since the last time we talked. I think we talked right where we were kind of coming out of the April lows, the chaos of Liberation Day. We're a lot farther along now, and of course the markets totally different from where they were back then. They have roared back now to all-time high price levels, but also all-time high valuation levels. So let's kick it off here, Ted. Are these valuation levels sustainable, or are they crazy?
Well, they could be sustainable for a while, but it's not a long-term phenomenon. And so I think what happens when you get to this stage of the market, and this has been going on for a number of years now, you just keep getting more and more and more speculative. And when nothing bad happens, it gives you the ability to say, well, I'm going to get more speculative. And that's really where we are. But if you look at the numbers, I mean, if you look at the numbers they have for the S&P next year, earnings wise, it's like 16%, and we're still selling out at 24, 25 times forward, uh, 28 plus, trailing 12 months. I mean, you can have people play this market like that on a speculative basis, but if you're buying a company and you're buying something that's going to be a really great producing asset, you can't pay that kind of money for it because in the long run it won't work. So yeah, you could keep them going for a while, but um, you have to remember it's been a long time since we had, basically, it's been, uh, 17, going on 17 years, almost since the last, what I call generational bear market. So somewhere, in this next year or two, you're probably going to get to that point, and then, the game changes again. But right now, everybody's pretty drunk on where they are, so you can't sober them up right now.
All right, and that's kind of where I'm going. So let me put up a couple of charts that you prepared. Um, the first is a chart of just U.S. stock valuations, and this is sort of a composite valuation metric. Brings trailing PEs, CAPE ratios, all sorts of things in here. But basically, looking back over the past 125 years,
Yeah.
this is the highest this index has ever been. And that's eclipsing the height right before the 1929 crash, before the market rollover in the mid 60s, and then obviously right before the dot-com crash as well. How much of a warning sign is this to you, and how worried does it make you about where the market could go from here?
Well, again, there's things in there. If you look at price to book, price to sales, um, you know, CAPE ratio, normal PEs, like the Tobin Q is in there, which is what does it cost to replace, you know, if the pricing is so much higher than replacement cost, then obviously you're overpaying for it. So all of those things together, market cap to GDP, every one of those is at a very high level. So let's just say you're a person you don't know anything, and so you say, I'm just going to statistically say what's in my best interest. Well, statistically, you're in that top 2% or 1% of time when it's too expensive. So do you want to bet the farm to say, oh, I think this is going to be great for the next 5 years? I don't think so, but it unquestionably would be an unusual time if that happened, and I don't think it will happen.
Okay. Now, the age-old wisdom in the markets is buy low, sell high. It looks very much like this is a buy high environment, maybe buy at the highest it's ever been type environment. So I'm going somewhere with these questions, but let me pull up another chart here just to sort of again set the table. You've got another chart you put together, S&P 500 price to book ratio. Again, here we're at pretty much the highest ever. When essentially what happens when markets get overvalued is they're pulling tomorrow's value into today, right? And that just means when you get to tomorrow, there's less value left over because it was already pulled in advance. Um, uh, we are, according to this chart, substantially more than a standard deviation, probably even two, above the norm here. What does history generally tell us? Like how reflexive is the reversion to the mean once you get this deviated?
Well, what happens is you know, it's just a situation with numbers. When you look at what goes on with that, it will eventually come back to the norm. And one of the things when you're paying such a high price over the real assets that you're buying, then you don't have any room for error, is what it amounts to. And I think that's what people forget about today. See, most people today are just buying the S&P 500 or buying some ETF or one of the high flying top Mag 7, Mag 8 stocks. And so they're not really thinking about valuations or anything at all. They're just thinking about, I'm going to buy this, okay? And I would say generally most of them don't know what's in what they're buying. They just know I got to buy it. And that's when you get into scary territory, because that also means on the flip side of that, once you start to get selling, they won't know what to do with that either, because they don't know why they got into it in the first place.
Mm-hmm.
So that's what you look at on that. But we obviously haven't been there, and everybody is in the same mode, which is, hey, we're probably never going to get a sell-off again or recession again. And
Well,
so,
so you've invested over enough decades that you've seen, a lot of variants of this movie play out before, right? And um, Darius Dale coins a phrase that I think I've talked about with you in the past, which is that the party gets at its most wild right before the cops show up, right? And a couple other charts that you just sent over. One here is of stock margin debt, which basically, stock margin is people borrowing to buy stocks,
right.
right? And again, we're at an all-time high there, at least an absolute high in terms of the amount of margin debt. And I'll put up another chart here too, leverage versus money supply, which is sort of a similar indicator here, which is that people are getting more and more comfortable kind of leaning into the speculation that's going on and using debt to fund it, right? And so to me, that's the market equivalent of the guy putting the lampshade on his head and dancing, on the table, right? Thinking
Yeah.
he's having a great time. Are you indeed seeing signs of that sort of like throw caution to the wind type of indicators that you typically see maybe right before the sirens can start being
Well,
heard coming down the street?
margin debt is one of them. That's why I sent it to you, because when people get so confident, they'll borrow any amount of money and just keep on making money. We'll borrow more money and make more money. But that's over 1 trillion now. That's a lot of money borrowed against the stock market. And they think nothing will go wrong. But you have to remember, in 1 year, one single year, between December 21 and December 22, margin debt, that's when you had that down market, it declined 50%. In other words, they had to sell them because they got in trouble. And all this does is adds fuel to the fire if you ever get some selling, because they have to sell then. And so you have, when everybody's borrowed up, and believe me, Wall Street's not going to help you out there. They're going to sell you out if you start coming down. But it's the same way in all leverage products. You look at private credit, private equity, um, and people, if they get a chance to leverage now, they leverage. And it means nothing to them to leverage, but that's one of the problems in the system. We have too much leverage. And when you have too much leverage, when things get really bad, then you really find out who's going to play ball here and who's not.
Okay, so I think I've set the table now where we've got these record high valuation levels. We've got a lot of warning signs, like way too much leverage in the system, as you just talked about. And there's a risk of just mean reversion with just those conditions alone. But now we're looking at the economic data and we're seeing that the economy is slowing. So we get to the question I mentioned in my introduction here, which is, seems like we're sort of on a collision course here where, either if the economy slows far enough, the market's going to have to say, you know what, we've been too euphoric here. We've got to reprice downwards. Or the economy could, start showing signs of greater life, and then earnings could catch up to valuations. One, do you have a proclivity one way or the other in terms of how you think this will resolve?
Well, I think it would in the short run, somewhere in here in the next 3 months or so. Even if you're going higher, I think it's going to throw the market for a loop, because all of a sudden, we are obviously worldwide it's slowing down. I
Right.
mean, real growth worldwide is slow, and the bond market's telling you, hey, look, it's not there. Okay. And I think what happens though is that it has everybody really sort of upside down this thing, because they keep thinking everything's okay. But if you start coming in now and everybody says, oh, you know what, we can't make those margins, we can't make that. Even on a short-term basis, you'll get a correction of some number that says, hey, this is not working right. And my guess is it goes that way. You get some selling, and everybody jumps to a conclusion that's not going to happen. And people don't realize, if you keep on lowering rates, there's something that's telling you that, hey, things are not so good now. That's why we're lowering the rates right now. So they'll forget about it, but that's when the market starts to come off too.
Okay, so you think gravity is likely to win here, and I think you answered more or less what my follow-up question was going to be, which is, I mean, it's unknowable, but of course the big question is, okay, well, when, Ted, when is all this going to matter? Do I still have enough time to jump into the party and have fun and be real long, or is this a time to really start to be a bit of a contrarian and say, hey, look, gravity may win out here. I want to position myself so that I'm not hurt too much if and when it does actually exert itself.
Well, I think to answer your question, if somebody had brand new money today, okay, I just came into a lot of money at a liquidity event or whatever, I know we couldn't certainly tell them that you need to be fully invested right now, because we just don't think that's where you ought to be. And we can prove it up by showing valuations of all the companies we follow, that none of them, we don't have that many that hit the list. And so obviously we're saying that to people. And I think the other thing they'll do is, with rates coming down, they're going to start to chase these yields. And we feel like that inflation has not gone away, and that the rest of this decade and foreseeable, it's going to be a hard asset thing. And so you're going to be in a situation where they'll chase these yields, and now a year from now, they'll regret it, because then they'll get hit again on the bonds. They will have gone out and bought this long paper, probably won't work. And all of those things fit together right here. But I believe that what would happen is, at least at the minimum, you get some sort of reset for people to say, hey, the earnings are not going to be there like we thought. I mean, think about S&P up 16%. These are estimates for next year.
Yeah.
I mean, I don't think we would ever get that. But we'll see. I mean, we'll see, I mean, but once you start having a change in a situation, I think that's where people have to reset. and that's where we are now.
Okay. All right. So again, like a great interviewee, you're anticipating the questions I was going to ask you. So yeah. So to the person who has dry capital right now, and again, your firm, Oxbow, it's you know your main business is working with people basically who've had liquidity events, right?
Mhm.
Entrepreneurs who have sold their company for you know tens of millions of dollars or whatever, or people that have had some inheritance or something like that. And right now, it sounds like you're saying, hey, patience is your friend, right? No need to kind of deploy a lot of that capital at today's high valuations. Wait for something a bit better. What would you say to people who are sitting on some really big gains, right? Who have really benefited from the past 3 years,
Yeah.
activity in the markets, and are sitting on some really big gains here, and maybe feeling pretty good about it. But is this the time to start realizing some of those gains and taking some off the table?
That's a good question, Adam, because I think most people don't address that today. If you look at, even for us, you look at stocks we've owned a long time. I'm talking about 15 years, like Microsoft and Apple, things like that. We still have some of those stocks. We don't buy them for new accounts necessarily, but what happens is we cut them all the time. And we've gone back in this year and said, hey, all our portfolio managers, we've had meetings about this and said, look, they're not going to want to do this, all right? But you're going to have to take some of that off the table and pay the tax. Because if you think about it, where could you go in a nasty down market? Let's say that potential is 50%. I don't know that it is, but it could be, okay, because it has been numerous times. Then it's okay to sell some stock and pay the tax on it. The other side of that, as I tell people, okay, let's just say, 10% of your portfolio is one of the big Mag 7 stocks. And my point to them is, look, okay, if I take 20 or 25% of that position out and you pay tax on it, okay, I'm not paying the tax. I understand that. But if you sell it and we get a cash out of it, and let's just say that that was a completely wrong trade, all right?
Mhm.
And over the course of the next 2 or 3 years, you're working on 80-cent dollars on this stuff. It still goes up in price if that's what happens, but it may be the reverse. So you give yourself leeway both ways, is what I'm trying to say. And you don't have to, I've seen this too many times, Adam. You get into a bear market and people will look back and say, gosh, I had a chance 5 years ago to sell that stock at X,
Right.
and now I'm down a half on it. I'm still up on what I paid for it, but gosh, I left a lot of money on the table. And then I want to go back to them and say, yeah, you should have paid the tax.
Mhm. All right. Obviously, folks, this is the value that a good financial advisor brings is the discipline to do this, especially when the party is raging and all your emotions just say, hey, just go fully long all the time. All right. I do want to come back before we finish up here about kind of what your more detailed advice would be to somebody who is sitting on a lot of cash right now. But we'll get there in a moment. So you said one of the things that you see that will be different about the future is inflation. That you expect that we will have secularly higher inflation ahead of us past next decade or so than we've had in the past, or at least sort of pre-COVID. Um, and you've got a chart here I'll bring up, which sort of shows the difference of what the market was like before kind of the Greenspan initiated era, and then now where we had a ton of inflation leading up to Volcker having to come in and crush it. We then had what's called the Great Moderation era, where we had really low inflation, or at least low reported inflation. But now in the post-COVID era, you're calling it sort of inflation again here. I'd love to hear your main reasons why for that. But let me ask you this, Ted. While I think your argument is going to be compelling, um, I know you're talking about the next decade or so. If the economy is slowing here over the next 6 months to 12 months, could we actually have disinflation maybe a little bit of deflation win out in the short term before the secular trend of the remainder of the decade kicks in?
I don't know that you would have deflation, but you could have less inflation, if you want to
Hmm.
call it that,
Yeah,
because what
disinflation.
happens is, let's just say right now, we're thinking that over the course of the next, you know, 5 to 10 years, your average inflation is going to be between 3 and 5 on average. And so let's just say on the short run it comes in at 2. I'll go 2 or something like
Hmm.
that. I think people will read into that and think, oh, that's great because we won't have it again. Just about the time, because if you look, there's virtually no way, if you look at the way our country's handling the money and you look at the indebtedness of all these other countries and a lot of situations that are going on hard assets, I don't see a way where you can't have inflation, because I think that's one of the few ways to get out of all of this. But the other side of it is that I think people are sort of devoid or light on hard assets.
Hmm.
So they're still in financial assets, but so they may feel good on the short term. And answer your question, you could get a little bit of that, but I think if you look back a year and a half or 2 years from now, that wouldn't have been the thing to do.
Thing to do. Yeah. And I guess what I'm asking is if we're looking back, in 10 years, we could say, Ted, you were right. Inflation was higher for the decade than before. But let's say the economy slows so much that we drop into recession for some period next year, could then actually pull the inflation down to a point where, we're at zero, maybe even a little bit negative for a short period of
Yeah.
time.
For the short run, it could, but it could also be like the 70s when starting in 66, you had a couple of periods there, 70, but the worst one was the second or third one was obviously 73, 74, but that was where you were going into recession, but the the prices didn't come down.
So
One of
true
the reasons,
stagflation.
yeah,
Yeah.
you went into that is because prices were going up, and I think people don't realize, but that's something that could happen here, just because of the way we set this up internationally now with tariffs and these basically cold wars against these major suppliers of major countries, that now you're in a position where you're not controlling your own destiny, because if the U.S. thinks that they can uh, basically head it off and get into a fist fight with China, Russia, and India, and those are three big, big economies, then I think they're fooling themselves. And what will happen is you'll end up with all kinds of deals on the side and trade this way, that way, but it'll end up with higher prices. And it may be you have a recession because of that, and the prices stay high. So you have to keep that in mind. It doesn't necessarily have to go the other way.
Okay. So the simple mindset of slowing economy means disinflation. It may not apply here. Could, but may not.
Well, that's what I think, because if you generally look at, you just take the core PCE, core CPI, and look at that relative, even the 10-year bond and the spread on that, it's right where it should be. Um, and then I think people kind of confuse themselves because they say, okay, the Fed's going to come in and lower rates by half a point. Well, that means Fed funds go from 4.5 to 4. Um, the prime goes from 7.5 to 7. Does that move the needle? I
On
doubt
the
it.
10-year, yeah, on where companies really borrow from.
Yeah,
Yeah, yeah.
I doubt it.
So okay, that's where I was going next with this, which is obviously uh, higher secular inflation for the next decade plus, more or less should correlate with higher bond yields for the next decade plus, because bond yields, to a large extent, are a function of inflation expectations, right?
Mhm.
Um, do you feel that same way? I sort of think you do, but correct me if I'm wrong. But B, kind of to my other question too, is what I'm trying to help people sort of think with both sides of their brain, which is
Yeah.
that, okay, yeah, bond yields could be higher going forward, but could we potentially be entering a period in the near term where economy is slowing? Who knows? Maybe recession happens at some point next year. Um, and or there's a downward market repricing as we talked about earlier, as everybody realizes, hey, the earnings aren't going to grow as much as we thought they were because the economy's slowing, where there may be a bit of a safety trade, right? Where, people will start buying the treasuries again as a safe haven, and that could potentially push yields down materially for the near term.
I think that could happen. But what would happen is, and this is, you just watch the average investor, they'll chase that yield. They'll think, oh gosh, because I'll give you an example. Now we're down to the point where the only thing that will give you 4% is a 90-day treasury.
Yep.
Everything else is below that now. Now for us, what we have done, we've done this in the past 2 or 3 years, is we've continually owned 3 and 4 year paper that's now coming in to be 2 year paper. But we've always tried to lock in for the next 24 to 36 months, because there's a period here where the rates come down like you're talking about. The average investor will chase that yield, but then they'll look up, that's what I was saying earlier, a year from now or 18 months from now, and they'll be sorry they did, because the long bond then will go the other way.
Right.
And I think that the trade here is going to throw people off, because they'll look at it and say, gosh, these bonds did really well. I mean, you could have a 15-point move in them or something. If you have a long bond, you have coming down, and they'll feel good about that. The problem is to give it all back, because as you inflate and you have that kind of thing going on, and look at our treasury, everything that goes into that, we just don't feel like you can own the long bonds. To me, we've owned them over the years. Don't get me wrong. We've traded them. We've done well on from time to time, but now it's not that time. And we just feel like if they can just say, okay, I'm willing to accept a little lower interest here for another year or 15 months, and then it'll start to go back the other way, they'll be all right. But if they get greedy and say, hey, I got to chase the yield and lock it in because it's going way down and I'll never get this yield again, that's the wrong thing in our opinion.
Okay. All right. Which begs the question, if you have enjoyed this era of T-bill and chill, especially if you're an older investor and you like income, right? You've finally been able to build a relatively safe income generating portfolio. As that trade goes away, right, as the Fed starts cutting here,
Mhm.
and you think long bonds don't go in there for the reasons you just mentioned, where does the income investor go? Does it become more dividend driven? Is it
Yeah,
more
I think
preferred
they have to,
stock?
yeah, I think they have a good question. I think they have to accept less income. However, in their other investments, a lot of stocks now are yielding 4, 5, 6. And again, you only pay 20% tax on that dividend. So you have to think about other things. Now, that doesn't mean you don't keep your cash stash, so to speak, but maybe now instead of earning 4.5, like we have the last couple of years, you're getting 3 or 2 3/4.
Mm-hmm.
And you might have to get that for a while. You might have to get that for a while. But I think you just have to accept it until you can see the light here, because we're in a situation where there's a reason they're coming down, and they may get real aggressive and bring it way down. But for us, what we've done, and I would recommend people to look at it too, if you haven't done it already, is just, push, like for us, we own 24, 30-month paper, we own 18-month, we own 12-month. So we have a lock-in on a lot of the bonds, enough to get us past the valley, we think, into next year, to where the rates will kick again, and then we'll be there. We don't try to trade that market or anything. I think generally you're going to find us to always be less than 48 or 60 months, especially in this atmosphere.
Mm-hmm.
But I think the average investor has to be careful. They'll try to chase those yields down, and it won't work for them in the long run.
Okay. Well, I know at Oxbow you run a couple of portfolios that are focused on generating income. And I know in them, you have some preferred instruments and
Mhm.
some other assets. Um, is there the potential, is the silver lining to a substantial market correction here from these stretched all-time highs? The fact that you might be able to get better yields on some of these other instruments, these more equity related instruments?
Oh yeah, no question about that. I mean, if you get selling in the marketplace, your dividend yields are automatically going to go
Going to
up.
go up, yeah.
So from that standpoint, you get the best of both worlds. You get a cheaper price and a better dividend. And I think that's what people don't realize. You have a different tax rate on that than you do on income from bonds.
Hmm. Okay, great, great. Well, look, I want to get to a couple specific asset classes, but real quick, I want to go through two other sort of macro uh, sectors. One is housing.
Uh-huh.
We talk a lot about stocks, but stocks are much less widely owned than housing, at least in America. And what I mean by that is the vast majority of financial assets are held by the top 10% of households, but a much wider percentage of households own their home. So what happens with home prices really matters from a wealth effect for the general consumer. And, increasingly, um, we know a lot of the same people, Ted, Danielle DiMartino Booth, Melody Wright, um, who are following the housing market and saying, hey, it's not looking good. And Melody actually has a quite, I would say, pessimistic view of the next couple of years of the housing market.
Mhm.
So what kind of role do you expect the housing market to play on the general financial markets because of a potential inverse wealth effect?
Well, on the housing market, I keep saying this, and I don't know if anybody agrees with me, but it's not the interest rate, it's the price.
Hmm.
Because with the higher price, and if you look at it, it's interesting. The last 3 years, they've raised the prices on new homes, and at the same time, the inventory's gone up. In other words, we're going to raise the prices, and we know we'll sell them no matter what. But what you have to factor in there is taxes and insurance on that higher price. So there's no way that just an interest rate play on it is going to change that situation. And then the other side is that people are in a state of denial. I see it all over the country. They think, okay, my property was worth X 4 years ago, and I know it's still worth at least that. So I'm not going to sell it for any less than that. All right. And so they're having to sit there with it. And existing home sales are virtually nothing. I'm talking about the worst in 30 or 40 years. I mean, it's
Yeah,
real bad.
frozen market. Yeah.
Yeah. So it's just stuck. And somewhere in here, and I think this will happen, all of a sudden you'll have people start ratcheting down and say, I got to sell this property. So I'm going to lower the price. But when that starts and you get into a buyer's market where everybody's selling, then you get a correction in the housing market, which nobody thinks that can happen, but it can happen. I've seen it more than one time. And when it happens, it throws a lot of people off.
And I'm just curious, what repercussions would you expect that to have on the financial asset markets as people start realizing, oh my gosh, my home's worth a lot less than I thought it was, and those losses start getting realized as people are
Yeah.
forced to sell their homes for all the reasons that people have to sell.
Yeah, I'll take the baby boomers for start and then go to the younger people. But on baby boomers, they're feeling really great about right now are their pension plans or 401ks and their home equity. Like,
Mhm.
I bought this house right 8 years ago or 10, whatever it is.
Or
That,
40.
yeah.
Some of them are sitting on amazing
So,
gains. Yeah.
yeah, you did that, but so what? So now all of a sudden it starts dwindling away from you. And maybe the market does the same thing. And see that'll impact a lot of people where they really they may say, hey, I need to get out of this. I and then if you look on the other side, I think if you look at cost of rent now, it's so much cheaper than owning that you're going to have to get some sort of correction there to get this thing going. And I but I think all of that will have an impact, yeah, in terms of the way people feel about it because they'll look up and think, well, you know what? I thought I couldn't lose any money in real estate.
Mhm.
I've heard that term. I've had people tell me that numerous times. Can't lose any money in real estate.
So, we have something somewhat similar going on in the consumer debt portfolio right now too, where a lot of people who thought, oh, I'm not going to ever have to pay back my student loans, suddenly realized that they had to. And
Right.
we're seeing spiking delinquencies there, and we're seeing that start to impact other forms of consumer debt, right? As people are forced to pay back those student loans, and they are being
Mhm.
forced because it's the one kind of debt that you can't get out of. And if you're not paying it, the government will just garnish your wages, right? Um, so we're starting to see people sort of steal from Peter to pay Paul, right? We're seeing delinquencies on auto loans and credit card loans and even mortgages start to creep up here. So that's a potential additional kind of shoe to drop here along with the housing market. And I think why all this really matters, or why I'm spending a lot of time thinking about it, is we talk about the economy weakening here. Where we're starting to see the weakness, I think, in the way that's spooking the Fed, is in the jobs market. Right? They're
Mhm.
starting to realize, what, the data that we were navigating by wasn't as good as we thought it was. And Ted, you and I and many others have talked about how we didn't trust the data much at all the past couple of years. But the Fed has now gone from saying, hey, this is a normalizing jobs market where everything's great, to, whoa, wait a minute, this is cooling off a lot faster than we wanted to. Um, as goes the employment market, so goes the economy. And uh, as there are issues dropping, like people having less discretionary income to spend because all of a sudden they're strapped trying to pay, their loans now, or they're feeling less wealthy because their house is all of a sudden starting to really lose value in a way they didn't think it would, right? You said nobody thinks housing can go down. They start, tightening their purse strings. That starts crimping corporate profits. And then corporations have to lay people off. And then people see their neighbor get laid off and they tighten their belts even more. And it creates kind of a vicious cycle. How concerned are you of sort of a downward, cascade like that happening, given today's current market conditions?
Well, I'll just give you one stat, and that is if you look at job growth, okay, any time in the past, and I may be off on this a little bit, but not much, any time in the past 50 years that year on year, year to year, job growth has been less than one, goes less than 1%,
Mm-hmm.
you're already in a recession.
Session.
Now, are we in a recession? If you look around, people would say no. But that job situation is the one that you should watch in here because um, we've obviously the whole thing with immigration, all that's having an impact. But but right now that's unquestionably slowing. And and yes, you'll get to the point where I mean I personally know three or four tech sort of white collar jobs that are out at work. They've let them go in the last 3 or 4 months, and for whatever reasons, and they're in their they're 50 years old plus, and they can't get a job. So it starts like that, and then it keeps on going to where people look up and say, "Man, I can't get a job." And but by that time, it's in the price, it's in the market, but eventually somewhere.
Yeah, it's your point about, asking somebody if we're in a recession. I actually think the answer is it depends who you ask. I know
Yeah.
from having read a lot of comments here, a lot of people are saying, hey, I personally am in one right now. And yeah, I think for all the reasons I mentioned, I could definitely see it potentially, expanding to more and more the population that feels like they're in a recession if we start sort of spiraling down like this. So, who knows what will happen? We'll keep our eyes on it. But obviously, the momentum is to the downside, which is why you got to be careful about this.
Yeah.
Um, all right, two asset classes I'd love to get your thoughts on. I know that Oxbow has uh, from our earlier conversations, Ted, thought that gold had pretty good prospects ahead of it. And congratulations, it has. It's had a great year, as has silver, as has the precious metals mining stocks. And I guess a key question to ask right now is, how much more does this have to run? Is this a bull market that has started and you want to ride, the bull while it's running, or has it moved so far so fast? Because we have had some amazing gains, especially in some of the miners. Is it time to start harvesting some of these gains, rebalancing, taking some stuff off the table?
Well, you have to look at it this way, and that is, if you own the mining stocks or the gold bullion itself, all right, and unquestionably you could come along and all of a sudden get some selling. I don't think it's the end of the run though, because the United States is giving us the perfect setup for the reason to own gold the next 5 years. And that is runaway debt, no control over anything at all,
Mhm.
and nowhere to cut. I mean,
No bringing in the deficit
no,
spending. Yeah.
we have no capacity to cut anything. And everybody overseas sees that. And that's why they're buying gold
Mhm.
and not
And,
buying the
and sorry to
treasury.
interrupt, but they're also in the same boat. None of them have
Oh,
much of a
yeah,
better. Yeah.
same thing. And so they're going a hard asset route. Now, I would say this, and because in a stock market sell-off, gold and the miners will come down too. They just do. In a stock market sell-off, there's only one thing that really doesn't go down, and that's the 90-day treasury.
Hmm.
But outside of that, they'll go to where anywhere they have profits and take them when you get into a nasty sell-off. So it's not that they couldn't get some selling, but it'll probably be like '08 and '09, where you come down and you get a sell-off. Yeah. But by the time you get to mid-year '09 or late '09, we're back at a new high.
Hmm.
And then you had two super years there off of that going forward. So yeah, you could get it. I think as an investor, when you own gold, the bullion itself, you just need to own it and say, well, if it comes off 15 or 20%, I'm not going to sell it because I bought it for the gold itself. Now, if you want to trade the miners, that's a little different situation. But they're very, very profitable right now. And I think they'll generally remain so, but nobody owns them. If I showed you the ownership of gold miners today, it's nothing.
So does that mean that, I mean, one of the promises of the mining space, right, is that when it did catch fire, um, the profits would be so good that the larger Wall Street universe would have to start paying attention. And if not that much capital moves in from the rest of Wall Street, because it's such a tiny market, like you're saying, you have a real
Yeah,
explosive version on price. So it sounds like you're saying the gains that we've seen so far have still been pretty much amongst the investors that play in the mining sector, and that the potential multiplying factor of other capital coming in from the rest of Wall Street, that phase hasn't really happened in earnest yet.
totally, Adam. That's exactly right. Because what happens is um, people really don't believe, they haven't believed in gold and gold miners. I mean, there's some firms out there that have, but they don't stop and realize that gold and gold miners have been the biggest return this year, but yet it gets no press. Like you're not going to see Bloomberg or CNBC have a lead story about, hey, wait, you should have bought gold miners or you should have bought gold itself.
Mhm.
And that's really sort of like what you want to see when you own it. You don't want, because once they decide, everybody decides they want to own that, it's such a small percentage of the overall market. When they push that money in, they'll drive those prices much higher than where they are now. Even if you've had a setback, they'll still do it.
All right. So what are you doing at Oxbow right now with your gold and your mining holdings? Are you just holding on to what you have? Are you doing any hedging? Are you doing any rebalancing right now?
No, not no. We haven't done that. Now,
You're riding your horses.
yeah, we've just kept the same companies. That's not to say we wouldn't. We've had a couple of companies that it's really, I mean, really done very, very well. Um, but as long as you're in a period where they're this profitable, and I can show the numbers of the multiples on these companies as well, they're very low, then uh, and people forget about this, but if you get in a move in an asset class and it gets doing really, really well, you forget sometimes that it could go much higher than that. And so you sell it after you make, X gain. Um, but we'll know more. I'll tell you how we'll know more is when you get your first selling and then you come back up, we'll
Hmm.
know more. We'll know more who's really the buyer there. And we'll know more on the profitability too. But the profitability is there. I think those companies over time, over the next 5 years, will go much higher.
Okay. Um, And another hard asset category, energy. Um, Energy has kind of been in the doldrums,
Mhm.
especially oil. It's a, it's an essential commodity. The world still runs on oil as much as, some folks would love to hope otherwise. And it's a cyclical industry. I mean, it goes through booms and busts. And so I'm very interested to get your take, Ted, because your firm's located in Texas. You guys can feel the pulse of the oil industry there. Um, when do you when do you determine, okay, it's time to start getting into positions in this space in preparation of a bottoming out of the cycle and then riding the next upcycle?
Well, for us, when oil went from 130 to say 70, 71, 72, we've added energy positions. Now, there's another reason we've added them, though, Adam. They have great dividends. I mean,
Hmm.
you look at the average dividend on our energy is probably 5 and a half, maybe 6. A lot of them are 7 or 8. And what happens is we don't buy a full position. We'll start to own some because here's the thing, oil right now to us is telling you that the world economy is slowing.
Hmm.
Wouldn't be 62, you know. And then remember the break-even price on lifting oil from the ground is probably 60 in the 63, 64 from
Probably
what.
right around there. Yeah, exactly.
So once you go to 45 or 50, and you very well could with the slowing of the economy, that means two things. They won't drill it up. And number two, um, people will lose faith in the energies, not realizing that they need to take that period and either add to what they already have, which is what we would do, or start a new position because these companies, the free cash flow on these companies is some of the best there is in the entire stock world. And I mean really good numbers, 8, 9, 10, 11, some of them are 12, 14% free cash flow left over after everything. And that's the way you want to own a company. You don't own a private company like that. But you may have to wait a while. And if it falls down to 45 or 50, which it could, I don't think it go a lot lower than that because of where break even is. But if it did, for us, we would buy a little more of it.
Okay. Is it fair to say, I don't want to mischaracterize, but is it fair to say that if you don't have a lot of exposure to the oil industry right now, that this is one of the better entry points that you've seen across your career?
It is. It's a good entry point because we look at free cash flow numbers and look on the other side, just the income side, for example. One of our strategies, we own the gas pipelines. Well, all of those top 4 gas pipelines we own, if you look at the average cash yield on that, it's about right at 8%. And most of that's paid on a K1. So you're deferring most of the tax on it.
Oh, that's great to hear. Yeah.
So a lot of people, they always say, well, I don't own a K1. Well, if you own real estate, you get a K1. So why worry about it if you own a gas pipeline?
Hmm.
Um, and so I I think what you have to do is get your foot in the water, a little bit and own some, pick some things out with great cash flow, get dividends, and be sure that you know that if I have to add to it, I could do that. And don't be afraid to do it.
Okay. Yeah, and it sounds like, I mean, it's a great time to be sort of dollar cost averaging into this industry, and you almost kind of hope it goes down before it goes up so you can get better values.
Well, you could conceivably in the next 5 years. I mean, it wouldn't be if somebody told me that you're going to go to a new high in oil. The old high was 130. If you go 150, 200, I wouldn't necessarily argue that point with them the next 5 to 7 years.
Hmm.
But you could do that.
Yeah, and certainly there are folks out there, Rick Rule, a highly successful natural resource investor.
Mhm.
I don't know what his forecast is for the price of oil over that time frame, but he has said that, hey, even if demand stays flat, which it won't, it will go up.
Right.
But he said even if it stays flat in the not too distant future, we're going to be seeing some pretty structural shortages because of diminished capex over the
Right.
past decade or two. So we have sort of sins of the past that are going to catch up with us anyways, that are going to be pushing prices higher.
Well, and the other thing that you have to keep in mind is something could go awry in the Mid East. And we're not talking about that right now, and I wouldn't buy it because of that, but that could happen. And that would be like 74 when you had the oil embargo and you had a recession, you had all that happen at the same time.
Right.
Um, I don't know that you're going to get into some sort of war where you blow up a lot of energy, but you could. And and you have to always remember that's part of it as well. But there's some good companies out there for sure.
And let me ask you this. I haven't looked at the data for a while, but I seem to believe that I have been hearing and reading some data that's suggesting that um, the U.S. shale patch the production may be peaking. Um, is that true? Are you hearing any worries could that be an additional contributing factor if we actually started uh, not producing as much from the shale? And I know there's plenty of other, it's not like we're going to run out. There's plenty of other deposits we can go after. They're just more expensive.
Yeah.
So, is there any talk of that is driving prices up over the next decade that you're hearing from
Oh,
your oil
I think
contacts?
I think you hear that about that, and I'm not I'm not a geophysicist or a geologist, so I can't get in any detail to back any of that up. Other than I talk to a lot of people in the industry, and they seem to bear that out. That it gets harder and harder to find. Your horizontals are getting longer and longer, on the drill,
Yeah,
and so But I will say this to you, and I've seen this before in the past. You let the price get real expensive, and they find it some way or another.
right.
And
Yeah,
I think they would do it again.
yeah. No, I do too, but again, it's cyclical, right? And
Yeah,
that's one of the
no,
main
it's
reasons why I
cyclical.
wanted to talk about this with you, because we're clearly at the down cycle where
Yeah,
nobody's interested. And that's maybe a great opportunity to get interested, right? As a
exactly,
contrarian.
exactly.
Yeah. Okay. Well, Ted, look, this has been fantastic as always. I've got two last questions for you I'd like to ask you before we wrap up. Um, one is at a very high level. I had a great conversation the other day, I think just yesterday, actually, at least the video released yesterday with Stephanie Pomboy. And
Mhm.
we were talking about the reshoring of American manufacturing. And, one of the things she said was, we just have to be aware that as we do that, which she believes is a good thing for us to do in general, but because we pushed off so much of our manufacturing to the rest of the world, we kind of pushed the business cycle onto the rest of the world, and we didn't have as much exposure to it over since the era of globalization started compared to beforehand. Meaning, if you look at charts of recessions, we've actually had relatively few since the globalization era compared to what we'd had before. And so, one of her warnings was just, hey, we need to be aware that as we start to reshore that, we'll be returning the business cycle more to America, and things might become more volatile economically as a result of that. Again, not necessarily a bad thing, but just something to be aware of. But her larger point was, we've come from this long period. I mean, really, pretty much everybody who's watching here, all or most of our adult lived lives, of kind of a Goldilocks era where we had low cost of capital, declining labor prices, and low input costs. Going forward, it's going to kind of look like the script is going to be flipped, where we're going to have increasing cost of capital, we're going to have increasing labor costs, and we're going to have increasing input costs. How big of a game changer is all of that in your mind, if you agree with that?
Well, it's a big change. Number one, you can't reshore very quickly. That's
Hmm.
the number one thing. If you start thinking about this, what if you start reshoring and then you have a political change at the top, in 28, and then all of a sudden it goes, you see, you can throw things off like that real quickly. But yeah, I think the other side of it is that no matter how we reshore, I don't think competitively we can compete with India and China on that pricing. And we're kidding ourselves to think we can. Yeah, it's great to have a lot of things made here, but if you look at the cost of production and our overhead cost here, you look at legal, insurance, all the things that go into running a business here. Well, they
Hmm.
don't have that. Okay. And so I think people forget about that and they just want to say, well, we're the US and, we'll make it happen. Well, we're not the driving force anymore. We're one of them, but we're not the only driving force. And I think that's the problem with the reshore is that um, we don't have much of it here. So you got a long way to go if you're going to impact it.
Yeah, I totally agree with that. But the trend obviously is still higher input costs here or sorry, higher labor costs here for us. When you
Mm.
combine that to higher cost of capital and then just higher, general inputs of commodities and whatnot, as you expect, hard assets for a variety of reasons will probably have a good run here if you're an investor, or a bad run from here if you're somebody that just has to deal with cost of living.
Right.
Um, how different do you think the investing environment's going to be in the next couple of decades because of those three, that sort of trifecta of things changing? And maybe I'm making too much of it. I don't know.
Yeah. Well, I don't think you are. I mean, I think you've got a whole set of investors today that have to go through another generational bear market at some point. I don't know when that is, but it'll happen. And they get like all of us have during investing periods. They that's how they get trial by fire, and that'll happen. Number one, and then number two, um, this always happens in investing over long periods of time. People will say, "Well, I thought I had it down. I thought I knew exactly what to do here
Mhm.
to make money. And it's worked great for the last 6 or 7 or 8 years." And then all of a sudden, they change the rules, they change the game. You can't make it work anymore the way you thought you could. And that to me is the kind of period you'll go into because we're still kind of brain dead on this last 15 years, and it's not going to look like that the next 15 years.
Okay. All right. Well, look, your point there about a generational bear market. I was interviewing, I think it was Jam Carson, who was reflecting on, um, the, well, basically there are periods of time where the market, goes nowhere. It's kind of a lost decade, right? Or a lost period of time in the market. And then there are periods of time where the market makes great gains, right? And if you kind of chop up the market cycles, over the past, I don't know, 200 years or 150 years on that, um, there's actually more, it's close, but there's more like lost periods in the market than there are periods of making the great gains. So a really important thing is to know, when you're, which part of the cycle you're in, so you can invest accordingly for it. But you and I have talked in the past about bear markets and kind of what their signatures are and what happens during them and all that type of stuff. Um, and I think we've gotten to a point right now, as you were talking about earlier, Ted, where people are just, exuberance is in the driver's seat. People aren't really worried about anything. Um, and they don't realize that actually half to the majority of time, the market's not making much money over time. And so they just don't think that these bear markets can come back when in fact they kind of are the norm.
Yeah, that's true. They get, again, it has to do with recent experience. And see, the Federal Reserve and the fiscal policy and for the last 15 years has ruined the investment landscape because they made money so cheap, so easy, so everything that nobody could lose. And that's unfortunate because then everybody has to learn the true lessons of money management, which is you don't need to always be fully in.
Yeah, and in addition to making things so cheap, capital so cheap, they also really did encourage moral hazard, right? A sense of like, if you take risks, don't worry, because we'll step in and we'll backstop everything.
Exactly. I mean, that's the thought process now is that, if we get selling, don't worry about it because they'll come in and back it up. But some of these days they may come in and try to back it up, but you keep on going down.
Right.
You're going to have
So,
that too.
yeah, so there's that risk. There's the tail risk. I don't think it's very likely that they just don't step in at all. I
Yeah.
mean, that hard to imagine, probably wouldn't happen, but that technically could. But even if the Fed does step in, people think, well, don't worry, the Fed will step in and I'll be fine. Well, you're going to take a lot of lumps before the Fed steps in, and not everybody who takes those lumps is going to, you know, benefit equally from the Fed's rescue efforts. So there's no guarantee that your losses are going to come back just based on what the Fed does.
That's right. I mean, that's true. You can't always depend on the Fed. I mean, the Fed is the one, they've messed up so many things, caused so many market problems that if you're depending on the Fed, you're really wasting your time. You got to be really looking at the companies you own, and I always tell everybody you're on your own. So, don't depend on the Fed.
All right. So wrapping up here, last big question for you, Ted, is again, your firm really specializes in, higher net worth individuals and families, especially those who have gone through or are about to go through a big liquidity event. We are in a market that does seem like if you're sitting on a big pile of dry powder, it's not one that you necessarily need to rush in and get long and everything for all the reasons that you and I have already discussed. What sort of parting counsel would you have to those folks? And again, whether it's a business they've sold, whether it's maybe an inheritance they've come in, or to our earlier point too, I mean, you might have had a windfall just by sitting on stocks that have done great over the past couple of years. And that, in a sense, you're in the same boat where you're like, look, do I keep them in these companies or maybe do I redeploy things here given how stretched valuations are? What if they were to contact you, like what would you, how would you start helping them think of what to do?
Well, I would tell them, first of all, you need to give yourself some optionality. In other words, if you're fully invested and things go bad, you don't have any options at that point because you didn't give yourself any optionality. And you need to always be investing so that nothing can really hurt you too badly. In other words, you have the right balance of equity, fixed income, real estate, whatever, but have that balance so that and liquidity, cash, so that you can really weather most storms. And I think people forget about having balance, but you really, I wrote a book about that, but you really have to have balance, I think, and to get through these periods. And that'll help you more than any other thing because you have liquidity and it gives you some optionality. If things get bad, you can own some stuff really cheap. But without liquidity, you have no optionality.
All right, that's a great point. And it's interesting when I was just starting out, I worked on Wall Street my first couple of years of business school. One of my classmates went into private client wealth, and probably something I would have been really interested in the long run, but back then wasn't so much on my radar. But I went to one of the interviews. I interviewed with one of the companies that he was interested in, just more or less to kind of go along with my friend at the time. And it was clear from the interview to the interviewer that I wasn't super serious about this. So we just kind of got to chatting, and he said, "Hey, it's key thing to know about this job, just in case you're interested, is it's not about our clients don't really they're not that they're not putting that much pressure on us to like dramatically grow their wealth. They just don't want us to lose it, right? They've worked hard to make this, or they've been fortunate enough to come into this, and they just don't want it to go away. And I know you and I have talked about this, Ted, that's a very common emotional state that especially a lot of entrepreneurs are in, who they spent their whole lives, in the trenches working, building, and all of a sudden their purpose for living is kind of gone overnight, and what's
Yeah.
replaced it is this big pile of money that they don't really know what to do with themselves when they get up in the morning, but they also, their skill set is not managing financial assets. It's building things, in a factory or whatever. And they have this strong insecurity of like, I might actually really screw this up. So, I mean, helping them figure out, okay, like first and foremost, having some liquidity, just some stuff you can fall back. Like it's a great process for help. Your firm has a great process for kind of walking people through how to think about, getting to a point of anxiety to a point of real confidence with this stuff.
We do. And, I tell all the portfolio managers, I say, look, if we lose an account, don't lose that account because you lost them a lot of money. Now, if you lose an account and they say, hey, you're not running gun, not aggressive enough for me. That's one thing, okay, and that's really okay. That's just a difference in philosophy. But I always mention to people, what you want to protect is your managed risk, because where most people get affected over long periods of time is they don't manage the risk. And so then they have to take years and years and years to make up to get back where they were. And it's only because they didn't manage the risk. And it was easy to do if they just think about it a little bit. And I think that's the biggest thing that we mentioned today to investors.
All right. Well, one of the things that's always impressed me about your firm is sort of the full service nature of it as well. I mean, you're great capital managers for all the reasons that we've been talking about in this video, but you offer a ton of other services, everything from the planning to really help people see, where their money will likely go in the future under all these different circumstances that you consider, but also just connecting them with all sorts of other, advisors when someone's trying to build up their full team,
Mhm.
of financial specialists, not just the portfolio manager, not just the financial advisor, but the tax person or the estate planner or whatever. So anyways, you guys take a great full team approach to all this. For folks that are interested in potentially talking to Ted and his firm Oxbow on, really, I think you guys are happy to answer whatever questions thoughtful money viewers may have. But for those that meet your high net worth minimums, folks can sit down and have a full consultation with you and just get your firm's direction on what you guys think they should do, and then they can do whatever they want with that. They can go do it themselves. They can talk to their existing advisor, or they could potentially talk to you guys about, hey, what it might look like to work with you. So if you're somebody watching who has that interest in maybe having that conversation with Oxbow, you can just fill out the very short form at thoughtfulmoney.com/Oxbow, and you'll be connected with them, and they'll reach out and find a time to talk with you. Ted, you mentioned briefly that you had written a book about the whole liquidity part. We did a great webinar a few months ago with your book about second generation wealth, how to raise financially savvy kids. Curious, what's your next book going to be about?
Probably next year. I mean, we already know what we're working on is we're going to talk about the significance of cash flow. I think if you look at any business or anything's productive asset, it always gets back to cash flow. And it can be free cash flow in a stock, or it can be dividends, it could be interest, it could be income from real estate. But I think people are less and less inclined to look at the positive aspects of cash flow, because cash flow will outweigh everything else in the long run. And that's what we're going to try to write some about what we feel like are some things you need to keep in mind when looking at cash flow.
All right. Well, look, when that book comes out, I'd love to get an advanced copy of it, Ted, but we'll also do a webinar for the Thoughtful Money audience on it, just like we did for the second generation wealth. And cash flow is the most important thing. Robert Kiyosaki, the guy who wrote the book Rich Dad Poor Dad's best-selling personal finance book of all time, he's kind of a polarizing character, but I know Robert really well, and absolutely, Robert lives and breathes cash flow.
Mm,
Almost to the exclusion of almost anything else
yeah.
in an investment. If the cash flow numbers aren't where he wants them to be, he's not even going to touch it.
Well, and it usually doesn't work. I mean, you look at companies that have no cash flow, you're totally betting on the future. That's it. That's your only bet.
Yeah, I
Uh,
mean, it really isn't investing; it's speculating at that point, right?
that's what we think.
Yeah, yeah. All right. Well, also, folks, quick reminder, we are still selling tickets at the low early bird price discount for the Thoughtful Money Fall Online Conference that's coming up in just a little over a month. That's Saturday, October 18th. If you can't watch live that day, don't worry. Everybody who registers for the conference will be sent replay videos of the full event, all the presentations, all the live Q&A. So if you haven't bought your ticket yet, please get it while we're still offering it this lowest price that we're offering. And I want everybody possible to get it at the lowest price possible. So to get your ticket, go to thoughtfulmoney.com/conference. And a reminder, if you're a premium subscriber to our Thoughtful Money Substack, look for the code that I've emailed you that'll let you get an additional $50 off of that lowest price for the conference. Ted, it's always a pleasure talking to you. Folks, please let Ted know how much you enjoyed your time here with him today by hitting that like button and then clicking on the subscribe button below. as well as that little bell icon right next to it. I kind of don't envy you guys at Oxbow, Ted. It's a tricky market to invest in. Like I said, with the slowing economy, I can definitely see some bumps and curveballs coming up ahead. But I know that your clients should be able to have a lot of confidence that you guys are going to be carrying them through it with a steady hand on the tiller.
Well, we'll certainly try. I have to say that we always try.
All right. Well, Ted Luck, you're such a great gentleman. You're one of my favorite people to interview. Thanks so much for joining us today.
You bet.
All right. And
Good to see
everybody
you.
else, thanks so much for watching.